Is it possible for your retirement accounts to be too big? Yes, it is, and we will explain how that works today.
So in this video, we're going to explain how to know if your retirement accounts are too big, whether it be an IRA, 401k, TSP, even a small business or a 403b. And if you determine that it is in fact too big, what action should you take?
So all of this sounds a little counterintuitive actually, because most people think that they want to have as much money in their retirement account as they possibly can. So explain to us what it means and how someone can know if their retirement account is actually too big.
Well, Amber, here's how you know if your retirement account is too big. When you do your retirement income plan and you plan out for 30 plus years, and you use very conservative rates of return, and you account for inflation, and you account for long-term care planning, if after all of that work has been done, there's still a big pile of money at the end, 30 years from now, your retirement account is probably too big. What I mean by that is you're not going to spend all of the money in your retirement account and the earnings it will produce.
So when you've projected out 30 years, if your projections show that there will still be a big pile of money, you know that your account is too big.
That's right. That's a good way to put it. Yep.
Okay, so what can they do about it?
Well, it depends. So it kind of depends, Amber, on what the beneficiary plans are. Do you want to leave that excess money to your children and grandchildren, individuals? Or are you going to leave it to charity? Because I'm going to suggest that depending on how you're going to leave it might depend on what action you should take right now.
Okay, so let's start with individuals. If you're going to leave it to family or friends, what should a person do if they find that they have this extra pile of money?
Well, Amber, we've already done a video on the best ways to leave an inheritance, so I'll recap that. But essentially it comes down to one of two actions. Either convert that money to a Roth IRA if it's in the form currently of a tax-deferred account, like the 401k, TSP, or IRA. If it's an after-tax money, perhaps from a business sale, then you want to perhaps consider life insurance. So let's talk about those two things.
Okay, so first of all, converting to a Roth. Why would you do that?
Well, the biggest concern, having a bunch of money left over 30 years from now, is what will tax rates be? And if you think about it, a lot of people, when they pass away, are going to be leaving it to their children who are probably in their 50s or even 60s, in their prime earning years, right? They're making top dollar. All their tax deductions are gone because the kids are out of the house, mortgage is paid off. So now they're going to be inheriting this money at potentially much higher tax rates. By converting to a Roth IRA, they can inherit that money tax-free and then allow it to continue to grow under current tax law for 10 additional years and receive those earnings tax-free as well.
Okay, so you're already leaving this big pile of money to your family members, and now you're leaving it to them tax-free.
That's right. Now, the other option, Amber, is a business sale. So a story I can share with you is last year, 2020, I had a couple referred to me. They had sold their businesses for a couple of $1 million. They knew they were not going to spend all of that money. We ran the projections, and sure enough, with Social Security and other rental income they had, they were not going to spend even half of this money in retirement. They wanted to go to their grandchildren. In that case, the recommendation was slightly different. They didn't have to convert to a Roth IRA. In fact, they couldn't. It was all after-tax money. So what they chose to do instead was life insurance, because life insurance will pass tax-free to those individual beneficiaries. So it doesn't matter what tax bracket they're in or what tax rates are in the future, the death benefit will now pass tax-free to their grandchildren.
So if you're looking to pass an inheritance to an individual, to family or friends, you want to consider either a Roth IRA or life insurance.
Now, I will say a couple tips, Amber, on the life insurance. There's always a chance that maybe inflation runs higher, rates of return are lower, or long-term care expenses were underestimated. If you're going to consider life insurance, we recommend a return of premium feature. That way, 25 years from now, if you need a portion of that insurance premium refunded to you, you can get it.
So it's not locked up tight.
Exactly, yeah. We're going to earmark it for the grandkids or the kids, but if life happens differently than we've planned, then we can pull it back into your possession if needed.
Okay, so let's talk about those who want to leave the bulk of their estate to a charity.
Well, Amber, this is a good question because Kiplinger's Personal Finance just recently did an article on this, what to do if you are leaving money to a charity. And I agree with the recommendation. Here's what they said. Charities don't pay taxes. So this whole Roth IRA life insurance doesn't matter to a charity. They're not paying tax anyhow. So don't go through all that. Instead, should you invest it differently if you're going to leave money to a charity? So here's what I mean. Say that you've got $1 million retirement nest egg, and we determined that really we could peel off $250,000 of that for this charity and continue to grow it for charity. The suggestion is perhaps you invest that portion earmarked for the charity differently, trying to get more growth, take on more risk, be more aggressive to grow that faster so the charity receives much larger funds in the end because it grew at a faster rate. Now, most people when they retire are more conservative. They don't want to take on a lot of extra risks. But if you consider this money going just to charity, then you might be comfortable taking on more risk in that account.
So if you find in your projections that you will have this extra nest egg that you want to pass on, make sure you talk to your financial professional so that you can either minimize taxes for your beneficiaries or pass it on to a charity as much as you can.
And you can always reach out to us at workwithnewgen.com to schedule a 15-minute consultation, see if we can help you in some way with this.
Because you can make the rest of your life the best of your life.
Plan now to retire happy.